Hello, my real estate investor and relocation friends. This is Ken Renner coming at you from North Austin Metro, Liberty Hill to be exact. I'm just located about 20 minutes north of the new Apple campus, just around Leander, Georgetown, Liberty Hill, which is the high-tech corridor where Leander's the fastest growing city of its size in the nation. So that's right where I live. And there's now an opportunity to be able to purchase homes in this area where you weren't able to purchase before, especially being an investor. Literally, for the last 3 years, you could not buy in this area, and I have a limited opportunity that a builder's given me exclusive, and it has to do with Rita Ranch. We're talking about the number one selling subdivision in the Austin area for 3 years, 4 years running. It's a total of 8,800 homes. Eventually, it's going to be the size of a small city, about 50,000 residents by the time we get done here. And they're about a quarter of the way through, about 2,500 homes. And so it's been very good for our investors and homeowners like me. I could have lived anywhere. I chose Santa Rita Ranch for a number of great reasons. I'm also going to talk a little bit later on about New Braunfels. It's my other really nice area that you can still get homes in the 200,000s that will cash flow great, great lifestyle, low tax rate, and good schools. So we're going to dive into this. This is my Austin presentation that I did out in Cupertino last week. Right now is October of 2022. We're heading into the final quarter of 2022, and boy, what a year we've had. So a little bit of background on me, if you don't know me already. I've been in the business now this is my fourth decade, 40 years in real estate. Got my license in Anchorage, Alaska in 1983. So next year will be my 40th year. An expert in real estate and investing. And I've been 30 years in Austin. We moved here in 1993. I got married in 93, moved my wife here, and then we started our family. And we've been in sales and investing ever since. Closed over $500 million in sales. And I consider one of the top investment brokers and experts in the central Texas area. It took me a long time to earn that reputation of being what we call a good old boy out here in Texas. Best-selling author, international speaker, spoke on many stages in regards to real estate marketing. I actually teach other realtors how to do what I do. Been on HGTV, three different episodes and many reruns, so that was a lot of fun. And I've also started the Hope Cause, and Hope Cause is homeownership possible for everyone. So this is a little bit of a mini resume, and we'll dive right into it. This is my House Hunters show. That I call it the Doctor Show because it's Dr. Hofarth and his wife. They came from California, from Lake Tahoe, California, and bought a house in Lake Travis, Texas, which is about 14 miles west of downtown Austin. And so it was a great time. It took a week to do the show for only 22 minutes. So I had 12 hours a day of filming, only 22 minutes of actual time on air. So this is my team. We have a number of support. You're not just dealing with just me as a broker. We have lots of support staff, and many of these people have been with us for many years. This is downtown Austin. I took this picture. Actually, there's been many more buildings since I took this picture. In fact, if you turn to the left on that from the Hyatt where I took this picture, the Google building is only a foundation there, so I must have taken this about 2 years ago. Back in 2019 and before, I think 3 years running, we're top of the best places in America to live. We would still be in that top position if it wasn't for the value of real estate that has gone through the roof here at Austin. And we're going to talk about the prices, what's happened in the last several months since the Fed started raising their rates. Still a great place to be where people want to move to. Massive amount of companies are relocating or already relocated here and building. Let's go down and take a look at some of these companies we've got. Well, first of all, you got the capital. That's we're the capital of Texas, and so we got a lot of government, state, city, federal. High tech, of course. That's the original Dell building in Round Rock. The toll roads make it a lot easier to get around. We do have a traffic problem on I-35, and so this is making it a lot easier for us to get, especially in the north side where a lot of the high-tech companies are. The toll roads really make it a lot easier to get around. This is a picture I took at Terra Vista Golf Course Community. Sold about 60, 70 houses in this neighborhood. This is Avery Ranch in North Austin, about 10 minutes from the new Apple facility. Sold over 300 houses in there. Started in 2000. The 1999-2000 is when this subdivision opened up, and if you recall, that was during the dot-com bust. Well, it never affected this subdivision, just like it won't affect Santa Rita Ranch the way it did. In other words, they opened it up right when there was a slowdown or recession in the Texas market, and we were buying houses here for $175,000. Those houses now are $650,000, even with the drop in prices that we've had just recently. So lots of boating, beautiful lakes nearby. This is our beaches, 85 degrees in the summertime is the temperature of the water. Live music capital of the world. That's my daughter down on the left. She played the opening weekend at the brand new Moody Center before Bon Jovi. And just last night she played the ACL 310 Theater for a national traveling act. Ariel was her name. So yeah, Christine Renner, ChristineRennerMusic.com. Okay, this is a high-tech map I put together. It doesn't have all of the high-tech companies, but it has a good majority of them. I had several clients say, hey, I just want to know what perspective is. Where are all the companies? So I put Santa Rita Ranch because that's where I live, and it's the number one selling subdivision in the Austin, Texas region. So the big news, of course, is the Apple. Oh, there's a number of big news expansions here, but Apple, Samsung, Tesla, of course, Oracle. So kind of just go down here, looking at, first we have the Google building. I don't think it's even opened up yet. This is a 33-story tower downtown. Beautiful building. I actually just drove it by yesterday. And there's a substantial number of other tech companies that are downtown, including several Indeed towers and what have you. Oracle, Facebook just took the largest lease. They took the whole entire top half of a building downtown. So Facebook is also not only here, but they're also in the domain. So Oracle downtown as well. Their new headquarters that moved out of California. Of course, 10 miles north, you have the domain, which is home of Amazon, Verbo, Facebook, and Indeed, and several other high-tech companies. Roku's there. So all about 10 miles north of Austin. Now, they have a brand new professional soccer stadium. So it's definitely an epicenter. They call it the new downtown or the second downtown. Of course, we have Apple. This is going to open up supposedly next year, spring, summer. We don't know, but that's the $1.2 billion facility in the northwest corridor of Austin. And so we're really excited about that. This is going to be more of your creative development jobs, software engineer types. Apple's already has a huge presence here, but it's more customer service and not as high paying jobs as they are going to be here in the Northwest area in the brand new in the building. So we're looking forward to the relocation, helping our clients buy these properties now at a discount, get in at a good deal. So that's what I'm here to help out with. This is up in our one of our submarkets, which is Temple Belton area, about 50 miles north of Austin. Meta is building a $800 million data center, and so that's putting one of our submarkets where I've sold over 200 homes in the last couple of years because the cash flow is so good and the quality of properties are great. But this now, though it's a major medical center up in Temple Belton, this is now putting high tech on the map in the Temple Belton area because of its central location. So then you have Tesla, of course, the huge, amazing building Tesla. And of course, Elon is continuing to be super bullish on what they're doing here with SpaceX and the Boring Company, Starlink, all that kind of stuff. And really, they're buying up so much land here. You know that they're going to be here for the long haul. And then guess what? If the Twitter deal goes through, he's been saying that they're going to move Twitter headquarters here as well. So that being said, huge amount of tech. Tech's not going away, and they're all headed this way. So this is, of course, one of the biggest announcements was the $17 billion Taylor plant. This is about 14 miles east of Round Rock in the northern suburbs of Austin, far northeast suburbs. Samsung already has a $5 or $6 billion facility in Pflugerville, just in North Austin. So this is going to be a complement to that. And this, like I said, all those other facilities I just showed you, that this building is worth more at $17 billion than all the other buildings combined. So it just goes to show you the kind of economic impact that these high-tech companies, and okay, I would believe that the high-tech companies are pretty smart cookies, and they're able to know that they wouldn't invest this kind of money if they didn't have they weren't bullish on the market. Okay, so what Bay Area? The house on the left is a house that one of my clients sold to reinvest, but that's about the difference between what you'd get in the Bay Area as opposed to Central Texas. In fact, this house just like this is available right over here, overlooking a 30-mile view behind, overlooking a valley in Rita Ranch, and it's right about 1.55. So this little house here in San Mateo, that client there, I call him Mr. Bill. His name was Bill. He ended up buying these. He did a 1031 tax deferred exchange and didn't have to pay anything in capital gains taxes because he deferred all the gain into these 9 properties. And that we were able to do that for him, and that's what we do. Specializes in deferring or avoiding taxes through the laws, and also through a leveraging to much more pleasant cash flow. So he was getting about $3,300 a month for that Guilford house there in San Mateo. He's getting about $13,500 a month for these 9 houses here. So it's kind of a question, where are you going to invest now? Cash, well, inflation's here, so that means your cash is worth 8 to 10% less every year. So although cash is king, we'd love to see people that pay cash for properties, so they have a war chest full of cash to be able to, or credit lines to be able to jump on the opportunities during the dip. Stocks, we know about the stocks. I'm not much of a stock guy, but I've certainly watched some of those, especially the NASDAQ and what's happened to it. Whew, man, that's scary stuff, especially when you're trying to maybe get to the point where you're in a retirement mode. That would be really, seeing stocks drop, Facebook down 50, 60%. So kind of scary for me. It's too much of a heart monitor investment for me, going up and down, up and down. Bonds, yeah, that's good, but it's not going to stay ahead of inflation. Commodities, that's a whole different game with gold and silver. Now, real estate, always, 85% of the wealthy in the United States made theirs through real estate. And so that's what I specialize in, and I specialize in affordable housing, which is never going to go away. We have the millennials, the biggest generation of adults moving into home buying age for home buying years. And they've been waiting. They've been watching for affordability as we're seeing the rates go up, and now we're seeing the prices come down. So it's we're seeing that the home millennial wave is coming, and so we're watching that. That'll stabilize the market for the foreseeable future. We're still 3.5 million houses short in the United States to keep up with the population that we currently have. So even though we have a glut of new construction houses right now that won't last for long, I'll tell you what's going to happen. Builders already starting to stop. They're stopping building. They're finishing what they already have going up in the ground, which is a lot right now. And then you've got the buyer dynamic. Buyers are kind of on the fence, so they're not buying. Then you have sellers that have this low interest rate that they refinanced into or purchased a couple of years ago, so they're kind of holding off on selling. So I'm going to guarantee you that we're going to have, once again, a housing shortage coming up in our metro and in other areas. Keep an eye on that, because as the builders aren't putting any more inventory on the ground, then we're going to have a shortage, which usually means if you're short, that means values are going to go up. But you got to buy at the dip. So won't go into the whole class on real estate basics, but it does offer income, depreciation, which is tax and other tax benefits, equity and appreciation over time, of course. The rule is, don't wait to buy real estate and wait. You've got to be a long-term investor or a short-term investor. We pretty much do the buy and hold strategy, which has worked out really well for our clients. Leverage means you can borrow most of the value of the property, and you don't end up having to. You get the benefit of the equity that's built, and that's where your exponential net worth can grow. It's relatively predictable. It's been kind of a wild ride recently, obviously, but didn't take a rocket scientist to say that there was probably going to be an adjustment down. And then there's some great estate disposition advantages. You can actually avoid if your parents will their property to their kids, they get what's called a stepped up basis, and they wouldn't pay the taxes that the parents would have paid, which is a huge number in some cases, had they sold the properties before their passing. So there's a whole class on that. In fact, you can go back to my Austin investment webinar and .com, and you can see a lot more about the predictions of what I talked about 3 years ago and why and how they've come true. So housing itself is a key hedge against inflation. It's basically a collection of commodities. Everything in this house is based on oil. The paint in the walls, the carpet house is made out of oil. The everything's made out of wood. It's basically a collection of commodities, and so that's your hedge against inflation, because commodities, as the value of everything goes up, just the cost of building and the cost of construction is going to continue to force prices up. There'll be some dips, just like there is now, and that's the time to buy. You don't want to buy the top; you want to buy in the dip. But the dips don't last for too long, basically because of what I'm saying. There is going to be a shortage of housing in the near future, again. Okay, so this is part of my podcast I did recently: change of season, inflation, rates, recession. The Fed's slammed the brakes on our economy, especially in housing. It was too much, too late. In other words, they should have started the raising of the interest rates a long time ago, like last year, maybe. When it looked like we were out of the woods after the pandemic, they should have stopped putting in trillions of dollars of incentive money, stimulus money, and they should have raised the rates to slow these things down. So now they're trying to play catch up, and that's taken its toll on the buyer mentality, the seller mentality, and the builder mentality. And that's what we're going to take advantage of. We're going to take advantage of the fact that this is when they need us the most, is when we get the best deals. The inventory is low still, but is rising quickly. We're at 2.6 months supply, which is highest it's been in probably 5-6 years here in the Austin metro. The builders and the sellers have to pivot right now. If you don't have to sell, and if you've got a rental property or a primary residence, I suggest maybe not selling at this point in time unless you have to, because people are trying to steal property. Now, if you do need to sell, takes good strategy, and that's what we're all about is working with the strategies of financing, creative financing, all the things that I've learned over the last 4 decades of doing this, including I used to own a mortgage company, so I'm very versed in the financing. Okay, all right. Inflation, it's a hideous thing. Doesn't sound like it's that much, but it is. Every time you go to the grocery store, you're looking at the gas pump, you're looking at higher prices, and that erodes the value of the money that you have in the bank. So if you have $100,000 in the bank right now, it's worth about $92,000 next year if this inflation stays where it's at. So the Feds are definitely very bullish on taking slowing that down, and they made they've made no qualms to saying that this is what they're going to do. So, but inflation is here, but that means also the value of commodities are going up, and once again, houses are a collection of commodities. So, I want to also encourage our clients that interest rates and recessions. Okay, so interest rates do go up, but they also come down. They spike. They don't go up and stay up, and they don't go down and stay down. Now, we've been lucky in the last the last 10 years that the rates have been sub 5%. Back in the 80s, when we had some dangerous times as far as inflation were concerned, we had 2 recessions that were kind of back to back. And Volcker, I believe that's the Volcker years, where he spiked those interest rates to slow the economy down. It did slow it down, and caused, as you can see, the spike in rates caused recession. Spike in rates causes recession. So eventually, though, it wasn't too long. 84, 85, 86, the rates dropped down to more reasonable rates. This is when I got into the business, so I'm very familiar with the different types of programs that are available right now that would be able to help this. Get through these periods of higher interest rates, which are hybrid loans, adjustable rate loans, and a whole nother seminar on that. Okay, so coming down to the 2008-2000, this is the apocalypse of the mortgage crisis. Oh yeah, we got your dot-com bust here in 2001. And you can see we went into recession like 2001, 2002, but it didn't last that long, and the rates they spiked a little bit, but then they didn't stay up long. So my suggestion is getting those 5-year fixed or your 7-year fixed, because it's going to look a whole lot different, and hopefully in a better way. Then we had our mortgage meltdown in 08, 09, and that was a little more extended, and that was caused by the real estate market and the mortgage market. And our current situation is not caused by the recession recession is not going to be caused by the real estate market, though we're already feeling the effects of it with what the feds are trying to do to slow things down. There was a short period back when the pandemic started, and that's when you can also see the rates were really low at the time, and then they drove those prices down right after, and so we bottomed out almost 2.5% interest rate. That's really, really artificially low. When I started buying in Avery Ranch in 2001, rates were at 6.75, 7%. That was the norm. It worked. It's fine. It was, that's pretty much more the range of where we're going to see. It looks to me more like that over the long haul. We're probably going to be more in the 5 to 7% range anyways, typically. So just be aware that mortgage rates and recessions spike. They happen for a period, but they don't last forever. So, and this is going back through the last recessions all the way to the 60s. That's when I was born, back in the early 60s. And you can see that even during all the worst recessions, including the 90s to 2000, everything but except for the great mortgage apocalypse, real estate has done fine through those periods. And so, very interesting chart. And so, yes, we had a big drop because of the mortgage crisis, but lending standards gotten tighter and tighter, and you have to put more money down. And so we're in a much different position now than we were in 07, 08, when anybody that could fog a mirror could get a loan, and that was just irresponsible. Lenders are not being irresponsible. In fact, they're probably being too conservative right now if you've tried to get a loan recently. All right, so once again, housing stays strong as long as you're not a mortgage apocalypse. Not big, I'm not much of a stock market guy, but I can definitely predict that when the, stock market versus the recessions is that when things start slowing down, during recession, stock market does not do well. And so, you can even see from here, if you were in 1995, and you held it for 10 years, you'd be at 2005 be up here, but then if you waited till 12 years, 15 years from 95 to 2010 almost, you would have been back to the same place. Real estate usually has a tendency to, although the numbers look good, the metrics look good as far as the line's concerned, but and over long haul, real estate, and stocks and bonds are great. It's always long haul. So, yeah, this is, of course, anybody that's in my high tech world knows about this, and so it's going back more towards the normal metric here. So though it was nice to peak out at 17,000 on the Nasdaq, it's only good if you cash out. It's only real if you cash out, and if you cash out, you have to pay taxes. So, that's why if you're for the long haul, you're going to do well. All right, so this is kind of the tale of the story. May 2020 was our peak of the market. Actually, this will reflect April numbers. So April technically was the high of the market. Prices were at 667 for the median in the city of Austin. That's up about double from where it was just prior to the pandemic. So I own a bunch of real estate, and so being that it's doubled has been a real blessing for me. All right, so it's 18% was the year-over-year increase from the previous year, and the point will be made here in a second why that's important. So we were at 1 month supply. This is just last May. So here's June. Started to see a little bit of a drop. We went from 667 to 615. Okay, this is the effects of the interest rates rising. We went to 1.8 months supply, which was the highest it had been in a while, but still very low because 6 months supply of homes is an average seller-buyer market. Then August 555. You see that's a pretty substantial drop. That is from the 667 to the 555. That's $100,000, $110,000 drop in values in a 3 or 4 month period. But though it was still 3% higher than the previous year. So what that means is that the previous year in August, the values at 2021 were 540. The current August numbers were 555. So, so you're looking at still 3% higher than last year. So, what it's saying is that the from last year we had a 15% appreciation rate, only all the way till May, and then we dropped another 15% back to where it was in August of 2022, 2021. So we're still ahead of last year as far as value. So you hear in the news, gosh, prices dropped 15%. I'm going, yeah, but they rose 15% in that same 1 year period. So we're back to 2021 prices, which is still pretty darn good. 2.4 month supply, which is a longer time than we're used to. And so we're seeing the average days on the market is still very, very low, 25 days on the market. That's very active. We've got 125% more listings, but that's still 20 for a city of 1.5 million people, 2.2 in the metro. This is still very low inventory. So back into rental market. It's a great time to be a landlord. Why? Because when buyers will wait and rent. They won't make a move if there's trepidation in their market. If they think the values are going to drop, they'll just stay put, or they'll move to another rental if they need more space. Rents are accelerating up, and so we're also seeing though more rentals hitting the market because of people that can't sell. They'll put it on the rental market, and that's another good niche for us. We love to help people put their properties, primary residences with those low interest rates into to a lease situation, because you still have a couple of years to sell it at a profit and still not pay capital gains. And affordable housing is still desperately needed. So we're providing affordable housing at a decent rental rate, and numbers work for us. So fast rising rents, we're number 3, Austin, and then of course our submarkets. We work San Antonio, New Braunfels. We work Temple Belton, anywhere from Waco in Central Texas all the way down to the far side of San Antonio. But Austin was up 32%, third fastest rising of rents. That's a pretty substantial rent. You're paying $1,500 a month for a 1-bedroom apartment. Now you're paying over $2,000 for a 1-bedroom apartment. That's why our rent houses look so good. Okay, so just another news article: the Austin climbs the second highest year-over-year rent increases nationally. Rents are very consistent on, going up year over year. It's like what we like to see, and we can see San Antonio's down here from started about 2012 at around $1,200 a month, and now they're up to about $1,750. That's about what we're getting for our medium price rental. And we're also seeing, let's say, Austin you get some dip in early 2022, but you're looking at what you were paying in 2020 was about $1,800, and now you're paying $2,100. So this is the great to be a landlord, right? Collect more rent. This also, another thing that's going to be interesting is that the mortgage payments, since they're gone up, it's actually right now cheaper for the red line here is having cheaper to affordability to have rents as opposed to the current higher interest rate atmosphere for mortgages. So like I said, mortgage payments up 31%, rents are up 15%. So there's a big disparity between what it would cost for you to rent that same house as opposed to buy it. So here's our opportunities and strategies that people come to me for. I did 156 sales last year. I did over 90 so far this year. And people are happy with what they've done with us. And so it's my pleasure to bring these opportunities to you. And staying ahead of it. That's what really put me on the map, is being able to predict what's going to happen just by following the trends, using my 40 years of experience in real estate investing, and become very aware of how market trends and geographic areas work. So builder inventory is rising. The investors are trying to liquidate. Some of them, I have a client right now. She started her property at $350. She's down to $325. She may get $300 for it now, but if it gets too much lower than that, she'll probably just go ahead and just keep it until and keep renting it out. We also are finding the people that have lived here for a long time are now heading out of Austin because of high prices, which translates to higher taxes. So if those on a fixed income, got a lot of retirees that are taking their money, taking their $500,000 tax-free exemption and moving. Sometimes they're just moving, half an hour, 45 minutes south or north to get back to affordability. And by the way, that's where we're investing. Not only in our Rita Ranch here because of opportunity that only comes around once in a while, but also in our submarkets, which is I said, half an hour, 40 minutes south, half an hour, 40 minutes north. Okay. We really have some great programs for 1031 exchanges. That's able to get your old, like I said, Mr. Bill's property, a 3-bedroom, 1-bath, turn that one into 8 or 10 houses. Great way to build wealth quick. We also have worked out a wholesale cash purchases for our investors, and that's exclusive to us, and that's in Santa Rita and in New Braunfels. Bulk purchases, that's what we're looking at, is we've got enough buying power that we're able to go to the builders and say, hey, sharpen your pencil, let's get these prices down. Can't do much about the interest rates, but we certainly get those prices down and make this more affordable so it makes our numbers look good. Right now we're out encouraging people to put 30 or 35% down on investments rather than putting 20 or 25% down. That way you don't have to feed it. And then the reverse offer strategy, that's pretty kind of cool, is that builders are coming to me, since I have such a reputation. They're saying, we got these properties here. Here's what we're going to offer them to you for. So they're giving me prices that are anywhere from 10 to 20% below current retail that you'd find on their website. So pretty exciting. And then syndications, somewhat similar to a syndication, is what we're doing, is we're using our buying power to be able to come with syndication type buying power. All right, so the builders are in a pickle. They ramped up building for the summer. That started all about this time last year. They started pulling permits after permit after permit to try to capitalize on the fact that we had a shortage, and by summertime we would have the most incredible 2022 summer buying season of ever. Well, that just petered out because the feds put the brakes on the kibosh on it. So now the buyers have the upper hand. They're offering. We're seeing people sitting it out. We're seeing people renegotiate their contracts. We're seeing builders offering $25,000, $30,000 in financing incentives to get their interest rates back down to the 4s where clients were used to. They are doing all kinds of things they're lowering their prices. Like I said, we're seeing some incredible buys, and they're not going to go too low, because what they've done is they've stopped building. And in other words, they're only going to build for actual buyers that are ready to buy and put their money down, rather than to investors and being speculative. So right now there's no more wait list like it was just 6 months ago. There's no bidding. There's no blind auctions. They've been very humbled, and I'm kind of actually enjoying watching them get a little bit more friendly and nice to us realtors and brokers that have clients that want to purchase properties. And like I said, 6 months, a year ago, they would say, investor money, no good here. You can't buy here. Well, now they're coming back and saying, we'll take a look at this investor opportunity. They're not doing a whole lot of it, but they're doing enough to make it an opportunity. Okay, so they're stopping building, but their labor and materials, there's still shortage with that, and the costs are still rising. That's inflation. So they're their costs are rising, and they don't want to continue to build houses that sit empty. So they're gonna, like I said, they're stopping building, putting things on pause. They're not going to stop completely. They're just putting things on pause until they work through this inventory, and that's where we're coming in and getting these great prices. So builders are calling us. It's pretty cool. So I think the near-term opportunities in the next 3 to 6 months to snap up properties. Like I said, we're looking at anywhere from 10 to 20% off of what the current drop price is. So here's this is my neighborhood. That's actually my backyard overlooking the North San Gabriel River Valley. And that white space down in there is actually a Toll Brothers community, part of Santa Rita. And like I said, this subdivision is 3,700 acres, 8,800 homes. It's not going away, and it's going to continue to be one of the hopefully number one for the foreseeable future. So it's a beautiful place. Prices range from anywhere from where we're getting homes, believe it or not, for brand new construction for $350,000. Onto this house here is probably worth $1.25 million, and then we've seen houses around the corner from here that are much bigger that are going for 1.55, 1.8 million. So you're definitely, if you're buying with us, investing with us, you're buying at the bottom end of the community, which will always keep your value there and support values on the way up. So Santa Rita is allowing our investors limited exclusive opportunity, and brand new homes are up to 20% off of the current listed price, and also exclusive inventory in the best school district, the Liberty Hill ISD. Just also found out that the tax rates just dropped in our area to 2.4, which is a 0.3 of a point lower. That's pretty substantial. So that on a $400,000 purchase would be $1,200 a month, a year less, so about $100 a month less in taxes. So that'll help in our offset some of the higher interest rates with having lower taxes. So there's the numbers that we're looking at, just under 400,000 for a 2,100, just over 2,000 square foot house. And so we also have the IO down here on the payment. The payment and management is 2882. IO means interest only. We have interest only products, which means that your payment's a couple $100 a month less, and you don't have to, and you can pay interest only, and you only pay on the balance that you owe. So we also this is one of the equity calculator that I look at. This is something, we're not getting rich on $100 positive or $100 negative, but what we are looking at is that we have built-in equity as we move in. I do my equity calculator to 7% appreciation rate, which is lower than the current inflation rate. So obviously, with a little bit of deflation that we have, but over the years, 6 to 7% has been historically over the last 40 years about what Austin and the surrounding areas have been going up. So with that said, the big deal is you're walking in because you're buying a property for $390. So I'm putting $430 here. Actually, they're selling them right now for $460 to $480, the same houses. So you're actually walking with pretty substantial amount of built-in equity. And these are contracts that they've signed. The builder in this case has sold 16 houses in August in this neighborhood. They sold 9 last month, and they sold 8 so far this month. So they're actually selling pretty well. One more thing that we're going to dive into a little bit: New Braunfels, great area. I'm going to keep this short because of the time frame, but this is south between Austin and San Antonio. Absolutely beautiful tropical area. Lots of rivers running through it. Very quaint German town. Lots of history to it, but also lots of character. Live music everywhere. Just a great place. It's actually the Leander, right where I live here, is the fastest growing city in the nation. New Braunfels is the 5th fastest growing city in the nation. So great place. And also, if you look, great schools, amazing lifestyle, jobs. They really do. Because of being on the corridor between Austin and San Antonio, 1.66 tax rate, low HOA fees, and then high price to rent ratio. So that's one of our other areas, but I'm very specific in which neighborhoods in those areas that we're actually buying. So we've got to be, that's what my 40 years of experience brings to the table. Same thing, you're going to end up with actually a positive bigger positive cash flow. Same house is going to be renting you basically just anywhere between $1,700 and $1,900 a month, and the rents are $2,100, so you're going to get a positive cash flow. Okay, so things we have to depend on is the financing strategies I had to learn in the 80s: adjustables, interest onlys, buy downs, how to use discount points the builders are willing to pay, adjustables, hybrids, once again for a whole nother seminar, but I'm very versed on the creative financing options that are available to us. And I like the interest-only credit line purchase. There's a mortgage that we have that's interest-only, but it's also credit line, which means you can, as you buy it down, as you pay it down, then the payment drops because it's based on the balance. But you also have access back to that equity if you needed it later on. So that's really kind of cool. So let's say I owe $300,000 on my rental property, run into some cash, I'm going to pay it down to $200,000. So my payments will drop because it's based on the interest-only every month. But if I needed access to that cash, they give you a checkbook. So you can, really, really cool program. So I cut my teeth on the financing business. I was owner of a mortgage company for many years. And so I'm very familiar with it. I can run the numbers backwards and forwards, especially with this new, where we're headed with the new financing atmosphere. Adjustables are back. Also, we have a way to help you buy with cash. And this is great for 1031 exchanges because we can help you buy a property, get it leased prior to you closing on the previous home. So this is Homeward. Homeward.com is, and Blake Outlaw is a friend of mine. He's the director in it. We've had many conversations and are doing business right now with Homeward, where they use their cash, they buy it for us, and then we buy it back from them at the same price that they pay it. And the only thing that they do that is different is they pay the cash up front, and then if you use them as the mortgage company to do the final financing, then they wipe out the fees for borrowing the cash up front. Didn't cost you anything. So I'm excited about that, and it's a way for you to buy a performing asset right at close. So we can talk about we'll be interviewing Blake in future presentations to talk about this program, because it's a great way, especially with 1031 exchanges, to be able to acquire the properties ahead of time with cash and then close on them after you get your exchange property done. Okay, so hit this action items. I know it's a lot to cover. I wanted to keep it quick because your time is valuable. So I want to help you out. If you're interested in opportunities that we have that are getting further and fewer between as far as what makes sense, then give me a call. You can use my scheduler, call ken.com. You can email me at ken@byaustin.com. You can text me for quick questions, and then, of course, watch my podcast, kensradio.com, and then my YouTube channel is kenrenner.tv. So I look forward to connecting you with the on-site agents with the limited amount of inventory opportunities that we have, both here in the high-tech corridor in Rita Ranch and also in the New Braunfels area with the low tax rates and the great lifestyle. I pride myself on finding the best properties for the clients in the best areas, and I've proven it year over year, and love to help you. And I'm big on education, as you could probably tell, and I coach our clients all the way through the process from start to finish. It works really well, because if we do well with that, then they come back and buy more, and they tell two friends, and those two friends tell two friends, and that's how we do well. So you're going to need to have experts and mentors in real estate at this time. Great time to buy. When everybody's saying it's not a good time to buy, that's the time that wealthy investors step in and take territory. So let me help you take some territory. Ken Renner, 512-423-5626. Have a good day.